Have you ever wondered what a credit score actually is? Who came up with these numbers and what do they really measure? Does a 740 score automatically means that someone will pay on time and will be a reliable business partner or a client? Today, we are answering what are these numbers, who created them, what do they actually measure, and why or why not they should matter to you. And last but not the least, who the f is Isaac and why is he fair? Hello, I am Felix. I have reviewed a lot of credit reports in my time. First as a loan officer, then as a lender, and now I am seeing credit reports as a business owner. Early on, I was struck how much data is boiled down just to one single score. The score that can decide whether the family gets a home loan or how much someone pays for a car. And sometimes difference of just few points means paying thousands more over the life of the loan for exactly the same product.
Oh my God! Okay, it's happening!
Let's talk about it. Most of you probably heard about the Big Three: Equifax, Experian, and TransUnion. These are three major credit bureaus that collect and organize financial data into credit reports and calculate credit scores. The other market player named Fair Isaac launched the FICO score in 1989. For those of you who wonder who Fair Isaac is, I know about this because very first time when I heard the name, I was curious where it came from. Believe it or not, internet was not as developed as it is right now, so many people had different versions about this name, but I couldn't really get the exact answer on what it really was. Luckily for you though, we do have Google and AI, so FICO means Fair Isaac Corporation. That's it. So back in 1989, this corporation launches a FICO score. By 1991, all scores were available for major credit bureaus. In 1995, Fannie Mae and Freddie Mac.
It's pretty confusing, right? Does it make you feel bored or stupid? Well, it's supposed to.
And those are US government-sponsored enterprises. Encourage industry-wide use for conforming mortgages and accelerated adoption.
Wall Street loves to use confusing terms to make you think only they can do what they do.
The purpose is a fast, standardized estimate of default risk to automate underwriting.
Or even better, for you just to leave them the fuck alone.
In human language, this means that using this score, banks or other lending institutions can quickly decide whether they want to lend money to a specific person or not. And Fair Isaac Corporation, also known as FICO, you get it? FICO score, is an American data analytics company that provides credit scoring models and other analytical services to businesses worldwide. Not just United States. What do these scores measure? Basically, credit scores show whether the person lending the money is likely to repay them back. In simple terms, if you borrowed the money before and repay them on time, your credit score goes up, and if you don't pay them back, the score goes down. That's it. The next question is, who uses these credit scores now? When I first came to United States, no one knew exactly what the good credit score meant and how to build it. But me, being me, I had to know how the credit score worked. Working in the industry and seeing lots and lots of credit reports helped a lot. And this is the data I'm going to share with you now. 90% of the data on the credit reports I've seen in my entire life was generated by credit institutions. These are usually the institutions that you get your mortgages or auto loans, for example, banks and credit unions. And then you have your usual credit card companies. American Express, Visa, MasterCard, you name it. Less often you will see bankruptcies and judgments on credit reports of people who had them in the past. And that is primarily connected to the credit institutions who reported those debts as unpaid. That's it. As I have mentioned before, Equifax, TransUnion, and Experian are three major credit agencies that collect and organize that data. The difference of these companies is going to be their scoring models, the types of information they report, and relationships that they have with different lenders.
That way, they can keep that profit machine churning, right?
Because not all lenders report to all three credit bureaus, and they use different data sets to generate their scores. Your credit report and credit scores will likely vary from one bureau to another. So in short, credit scores were created by corporations for corporations to assess their risks when lending money to consumers.
That's America's housing market.
A rhetorical question is, who is paying for the party? These companies profit by selling their credit reports and data analytics to businesses who issue credit, banks and lenders.
My firm offers ninja loans. No income, no job.
Nowadays, they also generate revenue by offering identity theft protection and fraud prevention services directly to consumers.
There are only so many homes and so many people with good enough jobs to buy them, right?
Now let's talk why credit scores are not the ideal tool to assess tenants when you are reviewing their applications. As we have learned, credit scores estimate credit default risk, not whether someone pays rent on the first or respects lease terms. It is very rare that landlord losses end up on credit bureaus. Many damages, skips, and unpaid balances never get reported. So a tenant can look excellent while owing money to their previous landlord.
Probably my looks.
Please do not forget that it also takes time for certain data to appear on the credit report. What is the crucial data that credit reports miss but landlords care about? Income stability and ratios. Credit reports do not contain information about person's income. Rental conduct, proper notice, keys returned, unit condition. None of that is captured on credit bureaus. That is when and why you need to contact previous landlords. Credit reports do not contain information about person's behavior.
What?
Do they respond quickly? Do they falsify documents? Do they show up on time? None of this information you'll be able to find on a credit report. So instead of just using credit report to assess certain applicant for a property, these are the tools that I'm using in conjunction with credit report. Income to rent ratio. This is the part where applicant needs to provide information about their income, whether it's W-2 or tax returns. From that information, you will be able to assess if the income is high enough for them to cover their debts from credit report and rent expenses. As I've mentioned in one of my previous videos, the link is going to be somewhere up here. We are usually looking for a debt to income ratio of below 50%. And by the way, this is the point where you are able to use credit reports to see what their approximate monthly expenses are. Rental history and references are not reported on credit report. And this is the point where you need to get contact information for their previous landlord and communicate directly with them if rent payments were made on time, and some other information as well. What were lease terms? Did they pay on time? Did they give a proper move out notice? What was the condition of the property when they moved out? And the main one, would you re-rent to that tenant? Last but not the least, you'll have to cross-reference all the information that you collected from the background check, including credit reports by the way, to assess if the property is a good fit for your applicant and yourself. In summary, credit reports were created for credit institutions, not landlords.
Got it? Okay.
Rent data is hard to get into credit files, and judgments or evictions usually don't show up there. Prioritize verified data from other sources. W-2s and court records are your helpers here. And do not neglect contacting their previous landlords. This is the most relatable information pertaining to your tenant search. So there you have it. Let me know in the comments below how you vet your applicants. Do you rely on credit scores? How much? And who ends up paying for all these reports? Other than that, be good people in real life, not just on credit reports. Keep bad tenants away from your properties and your heads, and I'll see you in the next one. Papa. These names, Fannie Mae, Freddie Mac. What are these names? Who was that person who came up with the name of Fannie Mae and Freddie Mac? What bothers me the most is the person who approved that idea.
Yeah, sure, let's call them that.
Here's the name, use it, that's it.